Hi all, once again welcome to our YouTube channel. So this is Dam Pro from Dhanesh Capital. So today is the one of the small video which it will explain basics of options. So this is an English series. So it will be a very short video kind of stuff where you will be able to really understand what is these listed stuffs. So what is call, what is put, what is CPE, what is option chain, where you can check option chain, ITM, ATM, OTM, what it is and where to look for those things. And again, lot size, what is option premium, where to check, and expiry date, what it is and why it is. Then capital required for either option buying or option selling, and then what is option buying, what is option selling, and then what is option strategy. So this will be a totally kind of consolidated video which will be covering option strategies till option strategies, from basics to option strategies. This may not give much detailed definition of anything, but this will be much useful to you in case if you want to have your view and build your option strategies on your own. So this series you can treat it as a very basic series, but this will be the building block for the future series. So we are going to see right now what is what. So again, welcome all once again to Introduction to Options Basics Part 1. So here we are going to see what is CE, what is PE. Generally there are two types of options available. They call it as American options and European options. So CA, PA, and again CE, PE, E stands for European. So this at all right now it is not much important to us. So we will ignore what is those, but we will concentrate only on what is call and what is put. Generally, what is call? When you are expecting something to be bullish in the sense something you are expecting the price to rise. Then in that case, if you have capital, then you can buy in stocks. So if you are an intraday trader, you can buy, but only thing is your view may not be holding till intraday, or you may not be able to have a capital to buy that much quantity. So in futures, yes, in futures it is possible. You can trade in intraday or you can trade using margin for next 4-5 days or till next 1 month by paying very little margin. But the risk will be much more in case if your view fails wrong. So in that case, what you can do is you trade on call option if you are bullish. And same way if you are bearish, means you are expecting price to go down from here. So in that case, you can buy a put option. So that is the purpose of call and put. So what is option chain? Option chain is in the sense it's a place or it's a table where against all underlying, let's say underlying in the sense what is the stock you want to trade. So for the stock, what are all the strike prices are there, so which you can select for buying. So what are all the expiry dates for the call and put which you wanted to trade. So these things are available in option chain. So where you can check option chain is, so this is the NSE website, this is the home page. So here you go live market, then you can check equity derivatives. So there all index related derivatives. So what is the underlying? So Nifty is the underlying here, and here some dates will be there. So this means this is the expiry date. So whatever you are seeing, that will going to expire on 13th of August. So again, if I select 20th, then whatever is going to expire on 20th August. So till that date I can hold this options and futures for this expiry date. So like this, so many expiry dates will be there. So these are all the weekly and end of the month will be there. That is only monthly. So you can trade it in monthly or you can trade in weekly. And here in the center you will have strike prices listed. So here most of the whole number series or round number series will be listed. So these are all the strikes where you can trade. So here this side calls will be there, the left side, and the right side puts will be there. So here you will see what is the ask quantity, what is the ask price, what is the bid price, what is the bid quantity, what is the net change, what is the LTP, what is the IV in the sense implied volatility, but we will see in depth all these things, implied volatility, change in OI in the further videos, but right now just concentrate on what to check and where to check. So here LTP is there, so this LTP is called option premium. So for this strike for this call, this is the premium. Why it is called a premium? Because generally calls are whatever options are, it's an hedging instrument. Hedging in the sense which will save you from any catastrophe or uncertainty. So you remember insurance. So that's where you use word premium, right? So generally to save you from some uncertainty or from unexpected things. So you can correlate that as here. So premium. So this is the strike. So for this strike, this is the premium. So this is option price. You can call it as option premium. So where to check the lot size? So here it is only showing what is the ask quantity or bid quantity, but you don't know what is the lot size of one single strike. So in that case, you can go to the LTP and just click here. One more window will open up. So there you will see all the details. So what is the, so it is the expiry date of 20th August. This is a call. So 11,200 strike. So what is the price here? What is the previous close? What is the open, high, low? So it's like almost like shares. Everything will be there. So this is the market depth. And this the traded volumes, all those things, and here market lot will be there. So this is the lot size. So this is the minimum quantity where one can trade, either buy or sell. So this is the minimum quantity. So this and all, like we will see in the further videos, what is open interest, change in open interest, what is implied volatility, all those stuffs. So this is where you need to check the what is the lot size. So as per this one, till now we have seen CEPE, option chain, and we have to see what is ITM, OTM. So lot size we have seen, option premium, what is the option premium and what is the option price. We have seen expiry date also we have seen. So it's a weekly or it's a monthly, all those stuffs. So we have seen, but we need to see what is ITM, ATM and OTM. So what is ITM, OTM, ATM? Generally people call it as ITM means in the money, OTM means out of the money, and ATM means at the money. So if you look at the definition, yeah, it might be a little bit confusing, but if you are looking at this point of table, from here how to segregate, I will just give you a simple idea. So there are two sides, call side and put side in this table. So still there are some colors marking this. So this is a white color, this is a yellow color, right? So wherever this yellow color is there, that is, you can treat it as ITM because it is inside the money. Same way for the put side, the yellow color is there. So whatever strike, so 11250 PE is ITM. So the price at the price is something like the current price is 11,214. So you can take it as round number 11,200. So both the things 11,200 call and put, it is where at the market is, that is called at the money. So nearby, very close to the strike price or very close to the current market price, you can call it as at the money. Some people call this as at the money, some people will call this as the money, but you can consider both the things as at the money because it is in between. If it is exactly at 11,200, then you can treat this entire line as at the money options. So somewhere in the middle, so you can, it is up to you to consider what is at the money. So now you got it clear, right? What is at the money? So market is at 11,200. So this call is at the money, again this put is at the money. So again, what is ITM? So for the call, whatever it is there. So there are so many things, right? So here nearby, this is called nearby ATM. This is again deeper ATM. This you can call it as more deeper ATM. So this is how they term it. Same way, this is the 1250 is the nearby ITM put. So again, you can treat this as 11,500 as again more deeper ITM. Again, if you want to see 12,000, this is much more deeper ITM. Same way, OTM. OTM means outside the money. So wherever it's shown in white. So again, when the ATM is here, at the money is here, even the next strike it is called OTM. So it is very near to the out of money. That's it. This is nearby, and you can treat this as far OTM. This is very, very far OTM. You can treat this as deep OTM. So this is how people name it as ATM, OTM, because if you read the definition based, you will get lot of confusions, but for easier understanding, I will say you treat this method as to understand what is ITM, ATM and OTM, because whatever you are trying to do is, it is not the ITM, you are mainly going to concentrate on what is the strike price you want to select for the trade. So what is the premium of that strike price? So they call it as what is ITM. So 11,000 call is the ITM call. So for you, ITM or deep ITM is not required. You need to see 11,000 call, what is the price, what is the rate, and what could be the risk if you are trading. So only for that purpose, this understanding is much more enough. So again, we are going to see what is the capital required. So you are seeing what is the premium here. So what is the lot size also, you know. So 100 rupees for rounded purpose, you can take it as 100 rupees this option premium. So 75 is the lot size. To buy an option, to buy this option 11,300 call, you need so 115, or you can round it as 100 into 75. Lot size is 75. So total capital you need to pay is almost 7,500 rupees to buy this option at 100 rupees. So once you buy, you are the complete owner of it. You don't need to worry about anything. But in case if you are selling without buying, if you are selling, only seller, naked seller, in that case, by 7,500 you will not be able to sell the options, because generally for option selling, the margin required will be, which is equal to 1 lot of the future. So for 1 lot of future of Nifty future, it requires almost 1.2 or 1.3 lakh. So that much amount should be there as an option seller to initiate the naked sell of this option. So same way, even if you sell this one or this one round, even for 27 rupees, you need to pay more or less same future, but hardly it differs. Some 10,000, 20,000 might differ based on the strike which you are selecting. If you are going deep ITM, so if you are selling 11,000 call for 300 rupees, then your margin might little bit increase more than future also, because it needs to be like you need to consider that by paying this you can take the future, but if tomorrow market goes 100 point, then MTM, to match the MTM you should have capital extra to hold that position, otherwise your broker will square off that position. So that is how you calculate what is the margin required for option buying and option selling. So now you got the point. Then how you will go for buying? So if I am bullish on market is at this point 11,200, I am expecting within 1 week market goes to 11,400, then what I can do is I can buy an option. So I am expecting within 1 week, so I can trade in maybe another 7 to 10 days to expiry. That kind of expiry I will select. So if I select 20th August, if my whatever target I am assuming, if it falls on that 20th, before 20th, then I can trade in this one, or else I can trade in 30th August. So again 13th August will have different premium, because it depends upon the many factors like time, what is the movement, what is the IV, all those things. So that details and all we will see in next part of the video, but only the basic things we will try to understand from here. So again, if your view is within next 2-3 days I am expecting 11,300, then in that case I will buy 13th of August expiry. So you can buy even 11,200 call also if you are bullish, and if you can buy 11,300 call also, and if you want to buy, you can buy this one. So if you buy this, what is the capital required? So whatever the LTP into lot size. Again, if you buy this, what is the LTP into lot size? Again, if you want to buy this, so this is the lot size. So again, with lesser capital you can trade, but the thing is you are leveraged here. So you are expecting Nifty to be bullish, and you are not trading in future, or you are not trading in either cash or the ETFs, because Nifty is not listed in cash, so you can buy it in ETF if you want to have a bullish view. So but we are not paying that much amount, because if you want to buy in cash or something like that, then you need to multiply cash price. So 11,200 into lot size is 75, so that much money you need to pay for trading this bullishness view. Whereas in future you trade only with so whatever is there, 11,200 into 75 means 7.5 lakhs will come, but in future we are not going to pay 7.5 lakhs, maybe we will be paying 1.5 lakhs only, because that is margin. Again, even I don't have 1.5 lakh, in that case I want to trade my view on this Nifty bullishness, then what you can do is you can buy 11,300 call. So 60 into 75, so only that much you need to pay. Less than 6,000 rupees you can initiate the trade. So this is how option market works. Again, if you are bearish, same way you can buy based on whatever margin or whatever risk capability you have. You can buy this put, or even you can buy this put, or you can buy this put based on your expectation and your expected target. So this is how these things are. If you are a seller, then if you are bullish, what you will do? If you are a seller, then if you are bullish, then you need to sell put, right? Because if you are a buyer, you will buy a call. Again, if you are a seller, then what you need to do? You can't sell the call because that is bullish. So you want to sell a put. So again, for selling a put, the capital required will be almost equal to or little bit more or less equal to 1 lot of futures. So to trade this, so 85 into 75. So hardly to trade a value of less than 8,500 rupees, but you need to pay a margin of 1.5 lakhs. So that is the difference between option buying and option selling. Then what is strategies? Generally people call it as strategies, right? So what is that? It is not a new thing or it's a complicated thing. Only thing is option buying, now you seen, option selling you have know also. What is the option strategies? Option strategy is just a combination of one leg of buying. It can be the second leg can be 1 lot selling or 2 lot selling. Though there are many combinations which you can create option strategies. It can be n number of combinations. So generally you don't need to worry about what option strategy I need to execute. It is only based upon the view you have and the capital you have and based on the risk you are having and based on the view and how long my view will be going to get. How long it will take to my view reach. So based on that you can build option strategies. There are some people who will sell in social media like this strategy I have built, this strategy I have built. Only thing you need to remember is there is a difference between discovering something and exploring and finding something. So option strategies, it's an explorable content. So you can do all kind of combinations like 1 lot buy in future, 1 lot sell in option. It can be a call, it can be a put, and again 1 lot sell in call, 1 lot buy in call. Like that there are n number of combinations that consist of option strategies. So it is not a defined way to do anything. Only what you can do is you can construct option strategies based on, first of all, your view should be there. So whether I am expecting bullishness or expecting bearishness or I am not expecting any move at all. So based on that you can have strategy. Again based on your capital, whatever capital you have. So based on that you can build strategy. Again this much only is my risk. Even if I am bullish and even the market turns anywhere, it can be go wrong by 1000 point also or 10,000 point also, but my risk should be only this much. Based on the risk definition you can build strategies like that. So this is how strategies will be constructed. So I hope all these basic things will be very clear to you. So maybe in the next video we will be seeing what is the next part of options basics, which will be covering how options is priced or what are all the basic components of option pricing. So how do you calculate risk based on that, or how do you define your risk, or based on your risk how do you select options, select strike price, or how do you whether go for option selling or option buying, or how to build option strategies based on after understanding all these things. So we will have a small videos to understand all these facts. I hope these things will be very clear to you if you are looking for a basic level education in options. So if this thing has helped you, kindly support us and follow us. If you have any suggestions or any criticism, please give in comment. Once again, thank you. This is Dampro from Tanish Capital.